Welcome back. You're still with us on Markets Today. Let's go to the rest of the headlines now that we're tracking for you. The fourth headline today is GSW Steel surged over 2% despite reporting a major miss on EBITDA and margins for the second quarter. The company reported a net loss of over 900 crore rupees. However, the management expects an improvement in profitability in the second half of this fiscal. The joint MD and CEO of the company, Seshagiri Rao, also said that the benefit of lower coking coal and iron ore prices will be evident in the next quarter. Have a look.
In this quarter, we expect the steel prices to be stable and better volumes, and at the same time, costs are going to come down. So all this together, I think Q3 and Q4 of this financial year will be much better than what you have seen in Q2. The FOB price of China is $580, $590 per ton. If you take another $40 as the transportation cost and multiply by 83 rupees, which is a rupee dollar, and if you have to pay 7.5% duty and then add the port charges and other costs relating to imports, then the landed cost is almost equal or maybe slightly higher than the domestic prices today. Whatever prices as on date, if you take into account, and then see what is the benefit in cost that can come in the Q3 over Q2, then there could be $80 per ton of coal used in the consumption. That is the kind of benefit we are expecting to come in the Q3. As far as iron ore prices are concerned, the overall reduction which has happened in the Q2, that has happened in phases, something in July, something in August, something in September. So the full benefit of lower iron ore prices have not flown in the consumption in the last quarter. So that benefit also will come in the Q3.
All right, and let's move on to the fifth headline today then. IGL rallied over 6% and despite reporting a miss in its second quarter, the results were marginally lower than street estimates. However, the company reported a beat in revenues on a quarterly basis. Meanwhile, the management believes that the rise in gas prices is temporary. Sonal Bhutra joins in with the key earnings highlights. Sonal.
Spoke to the management earlier today and there was positive commentary coming in from them. But first, the numbers where it was a big miss on EBITDA. EBITDA margins came in at 14.8% versus expectation of 17.7%. EBITDA was also down 15%. EBITDA per unit came in at 7.1 rupees per SCM versus a poll of 8.8 rupees. Volumes, however, for the company at 8.1 SCMD were at a multi-quarter high. We spoke to the management and asked them their outlook for the coming quarters as well. And they said that the pressure on margins that they are seeing is temporary. They expect gas prices to go lower from these levels. And the Kirit Parikh committee, which was set up in order to revise the pricing formula for domestic gas, the outcome or the report should be out in few weeks itself. They are also looking at acquisition of a smaller city gas distribution player. It is at the discussion stage, but something should be finalized by this year end itself. And that is something which will add to the volumes for the company. That is what they say about volumes. They expect volumes to be around 10 SCMD in next 2 years. So that's a big jump from current levels. So positive commentary and expectation of a gas price cut also is something which is propelling the stock higher today. In fact, we spoke to the management. Let's listen into what they had to say.
Even if we earn slightly less, even if our earning per SCM is slightly less, we would like to grow to 10 million cubic meter per day. Presently, this quarter, we are at 8.09 million cubic meter per day. And we hope to reach 10 million cubic meter per day in 2 years from now. And that is our prime target because we feel that the gas prices are temporarily at such high. The moment the geopolitical issues are resolved and the government has taken a very significant initiative in the form of Kirit Parikh committee, we hope they will look at the problems that CGD sector is facing and they will come up with certain solutions that people are discussing about presently.
All right, that's on IGL. But Laurus Labs fell close to 6% after a weak second quarter numbers, as well as after the company went ahead and cut its guidance. Ekta is here with more details on that. Ekta, over to you.
Well, yes, Laurus Labs continued its decline into today after a sharp decline that we saw on Friday's trading session by around 8 to 9% after the company really cut its guidance that it had for FY23. Now, in terms of the numbers, they were largely stable. Revenue growth was 30%, margins at 28.5%. The growth was largely led by the synthesis division, which was up around 360% on a year-on-year basis, but the street seems to be skeptical about whether those numbers can sustain and how much of it was led by probably one COVID-19 related order. The pain point was the formulation segment, which was down 70% on a year-on-year basis, and that was largely led lower by the antiretroviral segment, which is basically the ARV segment, which did see some amount of volatility this quarter. The company has cut their guidance. So for FY23, they've cut their guidance by 10% for the $1 billion that they had, guided the street previously. They are expected to achieve around 6,500 crores in terms of total revenue going forward for FY23, which would still be a double-digit growth, but the street doesn't seem to be enthused at this point in time. The management, talking to CNBC-TV18, did mention that they do expect a recovery in the ARV segment in the second half, but when we asked them about whether or not the $1 billion would translate into FY24, they seem to be quite tight-lipped in terms of providing a guidance for FY24.
All right, Ekta, thanks a lot for that. Well, moving on, we also have Yash Jain joining in now to give us an update on what's been happening with the insurance regulator IRDAI, who has issued an exposure draft proposing amendment to reinsurance regulations. They've also proposed that the order of preference favouring GIC be removed, and stakeholders have been given time till the 11th of November to give their feedback. Yash has more on that. Yash.
Well, the insurance regulator has released a draft consultation paper which essentially proposes certain amendments around the Indian reinsurance sector. As far as these amendments proposed by the regulator are concerned, they seem to be taking away the biggest advantage which GIC-RE, the homegrown PSU reinsurer, has as far as the Indian reinsurance sector is concerned. The insurance regulator, through this draft paper, has proposed to remove the order of preference which essentially gave GIC-RE a big advantage in the Indian reinsurance space. To understand this better, I'll first take you through what the current regulations are and then what has been proposed against it. As per the current regulations, if any insurance company wants to reinsure any particular policy, what it has to do is it has to seek quotes as far as that policy is concerned from GIC-RE and also 3 FRBs or foreign reinsurance branches. Once these quotes are received, and assuming the lowest quote is from one of the foreign reinsurance branches, then that lowest quote has to be disclosed to GIC-RE. GIC-RE has to be given a chance to match that quote, and if GIC-RE chooses to match that quote, then the business goes to GIC-RE. The insurance regulator, through this draft paper, has sort of attempted at removing that particular order of preference. They put foreign reinsurance branches along with GIC-RE. What that does is that insurance companies will of course have to seek a quote from foreign reinsurance branches and GIC-RE, but they won't have to disclose the lowest quote to GIC-RE and give them a chance to match it. They can straight away give that business to the lowest quote, even if it's come from a foreign reinsurance branch. This does two things. This essentially gives the foreign reinsurance branches a level playing field when it comes to the Indian reinsurance sector. Also, it increases the competitive edge as far as the reinsurance business itself is concerned.
All right, with that, it is curtains down on this edition of Markets Today. Thanks a lot for watching. Keep it with CNBC TV 18.